The Federal Reserve is expected to raise interest rates for the eighth time over the past year to combat stubbornly high inflation.
Today's anticipated hike is expected to be the smallest since the central bank began pushing rates up almost a year ago. Experts believe the Federal Reserve will increase rates by 1/4 of a percentage point today. This move would bring the target rate to its highest levels in 15 years.
Joining us now is Javier David. He is a managing editor of business and markets for Axios. He's also a CBS News contributor. Javier, welcome. Thanks so much for being here.
Sure.
So, as with all sort of Fed announcements, just sort of set the table for us. Is this about what the Fed actually does, or what they say surrounding what they do?
The funny thing about being a Fed watcher is what they're going to do is usually telegraphed pretty well in
right.
advance. All of the heat and light takes place when they issue the statement because people get paid a good deal amount of money to parse that language. And also when the sort of Fed chairman, Jerry Powell, takes to the podium and he'll start elaborating what's going on.
And on that point, we do have confirmation that the Fed has decided to increase interest rates by 0.25, a quarter percent.
Right.
Tell us, Javier, since this is a smaller margin than we've seen in the other interest rate hikes, how is this going to affect American consumers, either who are taking out loans, who are carrying credit card debt? What are we going to see now?
Yeah, so while a quarter point is better than a half percentage point, the Fed's language in its statement says that they expect ongoing increases. So brace yourselves for higher mortgage rates, higher credit cards, and if you're carrying balances, I'd suggest you pay them off as much as you can because those interest rates are going to continue to creep up and consumers are taking out record levels of credit card debt, and this is going to cost them.
Yeah.
So we know that the previous sort of measures that the Fed took were really, we were told, a way to kind of put the brakes on inflation, not to stop it, because that obviously is a huge issue, a lot of factors going into that. But it was supposed to sort of slow the rate of inflation. How do you see this move today?
Well, that in fact, the irony is it has been happening that way. The Fed's ideal scenario was first and foremost to kind of whip inflation now, if you remember that old Nixon chestnut.
Yes.
And they have, because in fact, it appears, at least for the moment, that inflation peaked the middle of 2022.
So it worked.
Right. So on one hand, it worked. There are two things that the Fed is after. It wants to slow inflation, and it wants the job market to sort of tame itself. There's only one of those particular fronts is happening because we have a jobs market. Jobless claims is teetering near a 50-year low. The data that we got today on turnover, on jobless, what we call the JOLTS data, which is just basically a gauge of how many jobs are open and how many people are leaving jobs voluntarily. That data hit another unexpected high. So the jobs are still available, about 2 per every 1 person looking for one.
So we are now, given that we have, we've gotten the confirmation, it's a 1/4 of a percentage point, and that's also the smallest of the rate hikes that we've seen.
Right.
Does that indicate to you that that the economy is in fact starting to do what the Fed wants it to do? It's healing itself. The numbers aren't exactly where the Fed wants it to be yet. They're telegraphing that more hikes could be on the way, but this is less aggressive than we've seen, certainly.
Well, we're getting there, and so there is a lot of data that suggests that the consumer's starting to get tired. They're not spending as much. Inflation certainly it has moderated, but it has not been tamed. And corporate America is kind of positioning itself for a recession. And the irony there is a number of the earnings that we've gotten over the last several weeks have been stronger than expected. But again, the forward-looking guidance from corporate America is we think this year is going to be pretty tough, and we're going to pull back and act accordingly.
Yeah, what about that? Because, we were talking to someone earlier about the fact that last year, at the end of last year in particular, we kept hearing the R word, recession, right? So what does this mean? And if you're corporate America, it would seem that there was such volatility, right? Not that long ago, but now, what is the signal being sent here? How do you think that's actually going to be received? Is this a good move on the part of the Fed?
Well, the R word is still very much in play, and you're seeing it a lot or hearing it a lot from CEOs. But there's another word whenever they use the R word, which is mild. So the understanding is we're going to get the soft landing scenario. We're definitely, barring something really dramatic, we're not going to get a huge spike in unemployment. And that's what would really send the signal that this economy is in trouble, that would imply that the Fed would either stop its interest rate hikes, or it would even put it in reverse and maybe ease. And we're not seeing any indication that's going to happen anytime soon.
So let's step back just a little bit. Part of the reason why the Fed is increasing these interest rates is to try and get consumers to spend less, to ease the inflation. But we're not seeing consumers doing that.
No.
They continue to spend. Given the possibility that a recession, even if it's going to be a soft landing, is on the horizon, what's your advice to viewers?
I would say stop spending credit card debt, because that's the key. That's how everyone has moderated or tried to moderate an inflationary cycle, the likes of which we haven't seen in decades. It's tough. And people are spending, but they're earning more. So it's not a big deal because people are continuing to have jobs. They're continuing to get pay raises at their jobs. But the problem that we have now is that credit card, which fell off really substantially in the wake of COVID, has come up with a vengeance. And the fact that a number of people are carrying balances month to month is going to cost them a significant amount. And that's an indication, I think one signal to policymakers that consumer demand still remains probably, arguably, unhealthily strong.
All right. Javier David, so glad to have you here on set and have you analyze this breaking news for us. Thanks.
Thank you.